My name is James Setterberg and I am a CPA here at Elevation Tax. And I wanted to do a video representation today of how an S corporation could potentially save you a lot of money in self-employment taxes. So before we hop into the actual presentation, I wanted to give a quick disclaimer that none of what I say throughout the video should be taken as tax advice, nor should anything actually be relied on. If this is an option that you are considering doing, you'll want to make sure that you actually speak to a tax advisor to see if it actually makes sense to do. And then if you actually proceed with it, the tax advisor will be able to help you kind of get everything rolling and get everything set up for you to do this. So with that in mind, let's go ahead and hop into the presentation. So let's get started with a hypothetical example. And before I do so, I have to apologize. There is some massive construction going on right outside of our office. So apologize for any noises or things like that. Hopefully it's not too distracting, but just trying to wait for a time to where you can actually film the video and not have much construction, but that looks to be nearly impossible since they've got a lot of work to do. But so anyway, looking at the example, let's just say that a taxpayer by the name of Joe Taxpayer had an absolutely terrific year for a newly formed business. And so early in the year, he established his business as an LLC, which he was the only owner, which is a pretty common setup. The main service he provided was just some general business consulting. Joe was rewarded for all of his hard work and his determination and earned a terrific profit of $80,000. And this represents a figure of his revenue minus all of his allowable expenses, and that's what the $80,000 is. So since this was his first year he was reporting his business activity on his tax return, he wanted to make sure he did his tax return right, so he hired a reputable tax professional to prepare the return. So after he submitted everything to his tax guy, a week later he received his completed tax return, and he was absolutely shocked to see what he owed. His tax bill was not a little bit more than he expected, but actually thousands of more than what he expected. So how could he have possibly owed that much? And after kind of looking at the return, he noticed one large figure on his return that he really hadn't seen before, and that would be self-employment taxes. So the natural question is, well, what are self-employment taxes? So this tax is an additional tax on top of your ordinary tax that is on your net earnings from self-employment. And the tax rate is actually just a little bit above 15%. So when you actually work for an employer, the costs for these taxes are split. So as an employee, you would pay just a little bit above 7.5% of your wages in these taxes, and the employer will essentially match that as well. Best way to kind of show how that works and explain it a little bit better is by actually looking at an example of a pay stub. So for this particular pay period, this employee earned $1,000 in wages, and on the right there you see all of the deductions from those gross wages to get to a net pay of $709.74. So two of these line items on these deductions are the taxes in question, and that would be the Medicare tax and the Social Security tax. So these are known as FICA taxes for self-employed individuals. It's the self-employment taxes, but they're essentially the same thing. They're calculated a little bit differently because the FICA will go off of your wages. Self-employment, again, is off of your net earnings. But during this particular pay period, the employee paid $14.50 in the Medicare tax and $62 in the Social Security tax. So when you add those two together and divide that amount into 1,000, that would be just a little bit above 7.5%. So one thing that you wouldn't see is the employer paid portion of that. They won't put that on your actual pay stub, but rest assured, the employer is essentially matching that payment by paying on their own end the $14.50 and $62. So when you add those two together, obviously you get just the amount that's just a little bit over 15%. So the issue is, though, when you're self-employed, there is no employer. When you're self-employed, you're essentially fulfilling two roles. You're the worker and also the employer. Those terms aren't uh, really correct for being self-employed, but that's essentially explaining what's going on. You're basically acting as the employee and as the employer. So you as a taxpayer are responsible for paying both of those portions. So the obvious question after that then is, well, how do I avoid or limit the self-employment tax? One very popular method is to do something called making the S election on your business or establishing an S corporation. So an S corporation is a legal entity that is taxed a tad bit differently. It's subject to different type of tax rules than a single member LLC or a partnership would be. So unlike a single member LLC or partnership, the owners are also considered an employee. So as an owner, and as a worker, you pay yourself a salary. And then the excess earnings of the S corporation, the excess earnings meaning your revenue minus all of your expenses, which then would represent your net profit, that would essentially be the excess earnings of the S corporation, are passed through to the owners. And the important thing is that these excess earnings are not subject to the self-employment taxes. So contrast that with a single member LLC or a partnership. All of the net earnings that are passed to the owner are subject to self-employment tax. So there is some room to save in self-employment taxes. You wouldn't be able to completely get rid of it or avoid it, but you would be able to limit the amount that you pay. Kind of confusing at this point, but we're going to hop into example later into the video that will actually run some numbers to hopefully make this a little bit more clear. So after seeing his tax bill, Joe obviously didn't want to make the same mistake again for the next year. So when he sat down with his tax professional to discuss what can be done in the future years to help avoid this issue, his tax guy suggested making the S election on his LLC. Something I failed to mention on the last slide is that almost every entity that is set up, be it an LLC, a partnership, or even a regular C corporation, you can elect to treat that as an S corporation. Now, an S corporation does have some restrictions to it, so it may not work for everybody, but those entities that, as long as they're within those, if none of those restrictions apply to them, they would be able to make the S election on their entity. So since Joe was the only member of the LLC, he said, the tax guy suggested, well, maybe we can make the S election on your LLC, and that way you can limit the amount of self-employment tax that you pay. So Joe, obviously intrigued by this idea, but like you, I'm sure, really was having a hard time visualizing in his own head at how this would exactly or impact his tax return. So he asked his tax guy if he could put together some sort of presentation using real numbers to kind of demonstrate the potential of how much he could save in self-employment taxes by making the S election on his LLC. So the best place to start would be first analyzing and looking at Joe's tax return for the prior year, and just using those numbers and kind of translating them over to an S Corp, and then seeing how much savings you can have in the S Corp. So let's look at the single member LLC activity for the year, and this would be reported on a Schedule C, which is an attachment to Joe's personal income tax return. So on his return, he had $170,000 of sales, and he had about $90,000 of expenses to get to a net income of $80,000. So that's pretty straightforward. The S Corp return will look pretty similar to this, but there's actually going to be a few additional items that will be claimed as deductions that you would typically not see in a single member LLC. So as you can see, from the sales down to the rent, everything is about the same, but there's 3 additional deduction items in the payroll processing, wages, and payroll taxes. The reason that these are on here is again to emphasize that an S Corp owner is also considered an employee, and thus they can assign themselves wages, and then whatever net income is left over after all of these deductions are assigned, then that net income amount goes to the owner on their personal income tax return, and that amount, while subject to ordinary income tax, is not subject to self-employment tax. So that $30,625 amount will not be subject to self-employment tax, but it will increase Joe's taxable income. But we'll get to that in a minute. Just quickly wanted to point out those 3 deduction items that aren't on the single member LLC business activity. So first, let's take a look at the wages. So Joe will sit down with his tax advisor, and they kind of ran some numbers and did some research on what they felt to be a reasonable compensation for Joe, and that would reflect him being the owner of his company. That would reflect him being the only employee of the company, so the only one providing services for the company. And based on all those factors, they felt like $45,000 was a fair wage for that. Now, this is something you will definitely want to make sure that you speak to an advisor about, because there is a lot of room to game the system and save yourself more in taxes than you are allowed by keeping that low. The lower it is, the more risk you run yourself into in showing the IRS that you were actually fairly compensated for your job. So there's a lot of room to game the system. I could do a whole video on what kind of goes into this figure, what you need to consider when assigning yourself a wage and why it's important. But that's really not what we're trying to focus on here now. But just know that whenever you're trying to come up with a reasonable compensation amount, you want to make sure you talk to an advisor on that. The other thing is the payroll processing. So I would highly advise that whenever you set yourself up on payroll, that you have a payroll processor do all of it for you. So they would take care of collecting the funds from you to pay to you. It's kind of funny. You give all your money to the payroll processing company, and then they in turn just give it back to you. However, when you send the money to the payroll processor, there's extra payments that you have in there that go towards certain taxes, like the Social Security and Medicare, and there's a different taxes that an employer has to pay as well. So they'll make sure that they collect all of the correct amounts, and then not only that, they will make sure that they are remitting those taxes to the correct taxing authorities and making sure they're doing it timely. And then there's tax forms that go along with that, but they take care of everything, and it just makes your life a whole lot easier. Plus, this is an area of the tax law that you don't want to mess around with. These have some of the severest penalties if you do it incorrectly. So you want to make sure that it is done correctly. The best way to do it is to have a payroll company do it. Well worth the cost. Finally, the payroll taxes. This is the $3,375 amount is 7.5% of the $45,000. So if you recall, an employer pays half of that 15% in the FICA taxes or payroll taxes. And this represents the employer's portion that they're paying. They get a deduction for it. So after all of that's considered, the net income gets down to $30,625. So now let's take a look at how both of these affect your personal income tax return. So let's again start with the single member LLC. And I just want to assume a couple simple things before we calculate tax, things like that. But let's just assume that Joe's tax rate is 25%, and we're just going to assume that the self-employment tax rate's a flat 15%. Don't want to kind of get into all the tax tables. It's just not really the purpose of the video. Again, we're just trying to get a comparison of what it's going to look like when filing as a single member LLC versus an S corporation. So another kind of tricky thing about the tax code is that the business earnings within a single member LLC, whatever that bottom line is, not all of it is technically taxed at 15%. There's a minor adjustment that you make to it, and that will lower it. And then that adjustment figure that you just calculated, that's what's taxed at 15%. So for anyone kind of checking my numbers while watching this video, you'll probably multiply the 80,000 by 15% and look at that self-employment tax line of 15%. Be like, wait, that doesn't equal 15% of $80,000. This is all wrong. But rest assured, there was an adjustment that you have to make to the 80,000 and then multiply that number by 15%, and then that's where the $11,082 is coming from. And then as part of a single member LLC, you get to get an additional deduction that is half of the self-employment tax. So that $5,541 amount is half of the $11,082. So they get that deduction. So when you take the business earnings of $80,000 and you subtract out the self-employment deduction of $5,541, you get to a taxable income of $74,459. When that is multiplied by 25%, Joe's tax is $18,615. And then when added to the self-employment tax of $11,082, his total tax bill would just be a little bit underneath $30,000, or $29,697. So let's go ahead and take a look at the S Corp and how that flows through and how that works and how he actually saves some money here. So if you recall, as an employee of the S Corp, you're paid wages. The S Corp pays you those wages, and thus they're eligible to deduct the wages that they paid to you. So while the S Corp gets a deduction for those wages, you as the taxpayer, or Joe taxpayer here, has to report that $45,000 amount on his personal income tax return. Additionally, he's going to report the S Corp income of $30,625 to get to a taxable income of $75,625. So you may be looking at that first and be like, wait, I thought the S Corp was going to save me some money. My taxable income is actually higher, so how am I actually saving money here? But let's just keep going down, and I'll show you how this all kind of works and how trust me, you'll actually save money with the S Corp. So when you multiply the $75,000 amount by 25%, Joe's tax is $18,906, which is a couple $100 more than what he's paying as a single member LLC. But again, here's the savings. Here is where he's actually saving money, and it's with the self-employment tax. Now, this $6,750 amount is not going to be shown on his 1040 being an S Corp. I am merely just putting this on here because I want to show his kind of true cash outflow when it comes to all the taxes. So his tax and his self-employment tax. So that self-employment tax, 15%, is 15% of the $45,000 in wages. So both as him as the employee and him as the actual entity, the S Corp entity, Joe's paying a total of $6,750 in self-employment tax, or the FICA taxes or payroll taxes. So that's a cash outflow of $6,750. But again, that's not going to be reported on his personal income tax return. But again, just kind of trying to show you the total cash outflow of all the taxes here. So the total tax that Joe is going to pay is $25,656. And that will amount to a total tax savings of $4,041. So that's actually a good chunk of change there. I mean, there's many different things that Joe can do with that extra tax savings. He can reinvest in his business by maybe purchasing a new asset. Maybe there's a marketing campaign that he's interested in starting that will help attract new business and new customers. He can reinvest in that. Or maybe he wants to reinvest in himself and his family. Maybe he's worked really hard this year and feels like him and his family deserve a well-earned vacation. So really, it's whatever Joe wants to do with it. It's much better in his hands than it would be in the hands of the government, for sure. So he can either help himself or help his business. So there's one final note that I want to make before I close this video out. Whenever you make a major decision about your business, you want to make sure that you're weighing all the pros and cons of making that switch. And my point is that if the only pro is tax savings, it may not be the best option for you. There's a lot of different other things to consider when making a decision on whether or not to establish an S corporation or to elect a current entity that you have to have it be taxed as an S corporation. So as always, when you're making a major decision like that, you'll want to sit down with a tax advisor and make sure that you're discussing all those pros and cons to make sure that if you are switching to an S corporation, that you're doing it and that it will not only save you in taxes but help you in other areas that you're looking at. So that's the final note. And again, you just want to make sure that you're not making a major decision solely based on the amount of tax savings. If you have additional questions, click here to make sure you can book your free no obligation consultation. Also, be sure to sign up for our monthly newsletter and subscribe to our YouTube channel, and you'll get weekly updates. If you do have a tax question that you would like us to answer, please feel free to leave it in the comment section below. Thank you.